Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastep Jr.
Hello and welcome back to the Ask Ralph Show. My name is Ralph Eastep. I do this Ask Ralph Show every Saturday, and I want to remind you that we also have a podcast where we've done a ton of talks about all types of interesting things. Well, at least I found them interesting. And you can find those at our Ask Ralph website, or you can go to where you normally get your podcasts, such as the iTunes Store or Google Play, and just look for Ask Ralph. I thought today I'd take a few minutes and talk about a tax proposal that's come from one of our Democratic presidential candidates, specifically Elizabeth Warren. I'm not going to get into a big political discussion about Elizabeth Warren, but I want to talk about something that she brought out, and that's called the Elizabeth Warren wealth tax. And let me tell you, folks, this is a fascinating thing to read on. Now, it doesn't affect probably, 99% of the people in our country, but I think it's going to have some trickle-down effects. So let's talk about it. So Elizabeth Warren recently unveiled a plan for a wealth tax. And there's an article that was written by Matthew Frankel. He actually is a worker for the Motley Fool, and he illustrates this wealth tax, and we're going to talk about that. So this would apply to the richest Americans, those with more than $50 million in assets. So how would it work? Now, Elizabeth Warren calls this the ultra-millionaire tax, and she believes it would raise $2.75 trillion over a 10-year period. She cites economist Emmanuel Saez, S-A-E-Z, with this. And here's basically how it would work. Americans with $50 million or more in assets, no, we're not talking about income, assets, would be assessed a 2% annual wealth tax. Basically, take your assets, multiply by 2%, you send that to the government. Now, if you've got over $1 billion in assets, anything over and above that would be assessed a 3% rate. So you'd pay 2% on the first billion, and then once you get over $1 billion in assets, you're going to pay 3%. This bill would also increase funding to the IRS to help combat tax evasion, especially by the wealthy, and would also provide a one-time tax penalty on people who renounce their U.S. citizenship in order to avoid paying the wealth tax. So that's one of the things people have already started thinking about. If you want to get out of this wealth tax, then you just, you renounce your U.S. citizenship. Now, I'm personally not willing to do that, but of course I don't have $50 million in assets either. But so why is this considered advantageous versus the traditional type of tax? And let's talk about that for a second. So the traditional tax is an income tax based on income. The issue with that is, in practice, many of the richest households in the nation don't actually have a lot of income. Let's use Warren Buffett. They mention this as an example. They estimate he is worth $82.5 billion with a B. Now, the thing you need to understand is that is based on the value of his Berkshire Hathaway stock. Okay? So let's talk about some real-world examples here. So during the 2016 presidential campaign, Buffett released his 2015 tax return, which showed an income of about $11.6 million and had paid $1.8 million in taxes. Now, that's a heck of a lot of money to most people. But think about this for a second. In fact, the $1.8 million in tax Buffett paid represented just 0.2% of his wealth. And that's where this becomes a discussion point. The thought process of Elizabeth Warren and other progressives is that we're going to tax those people based on their wealth. So let's talk about the practicality of that. When we have an income tax, it's pretty easy to figure out what someone's income is. You got a W-2, you got a 1099, you sold stock, those type of things. Pretty simple. But it's going to be pretty complicated to determine the value of someone's assets. Think about it this. If you've got cash in the bank, well, fine. You can get the bank statement and say, okay, I've got, $15 billion. Nobody does this, but keeps $15 billion in cash. But what if the major holdings are real estate? Then we have a big opinion discussion. What is this building or what's this collection of properties worth? Is it worth $45 million or is it $50 million? It's a big difference. Big tax that could happen. Then we've also got the idea of what tactics would people use to avoid the wealth tax. We've already talked about, this penalty for renouncing your citizenship. I will no longer be considered a U.S. resident or U.S. taxpayer. But what happens with little games that could be played? For example, it mentions this article. Could someone with, say, $50.1 million in assets simply give $100,000 away to charity and avoid the tax altogether? And the bigger question is, what happens if someone's wealth isn't easily accessible? If you own a business that's worth $50 million but doesn't have any substantial assets, it's the value of it. Would you need to sell part of the business to pay the tax or take out a bank loan for that purpose? So there's an impracticality. And then we have to talk about, well, how about a threshold for married couples versus single couples? So here's a great example they mentioned here. If you, as a married couple, you've got $70 million in assets, well, maybe you get a divorce so you each have 35 and avoid this tax altogether. So the point is, there's a lot of logistical issues that would make this complicated. So then the bigger question is, could it be implemented? And that's where we need to talk about the legality of it. Is this even a legal thing? And ever since, Elizabeth Warren mentioned this, there's been some discussion about that. Some people say it's clearly unconstitutional. James Freeman, in an opinion piece in the Wall Street Journal, said that the wealth tax is perfectly legal. So as with anything else, it's going to get litigated. And that's assuming we even go this way. It's going to require a lot of debate, folks. And this is just the tip of the iceberg of what we're going to see. We've got an incumbent president that's going to be running for re-election. There's no doubt in my mind about that. And you've got these Democratic presidential hopefuls who are trying to make a name for themselves. And this wealth tax, if you think about it, affects a very small portion of the population. And the truth is, most people are envious of people with wealth. That might not be a popular thing to say, but it's true. So if I'm running for president and I want to get, the average person's vote, this particular tax would be, hey, you know what? It doesn't affect me. I'll never have $50 million in assets. So I see something like this as a distinct possibility. Now, the question of unconstitutionality is something the Supreme Court would have to decide. I'm not an attorney and not a legal scholar, so I can't really address that. But it really does bring up a question of, does it make sense for us to tax a person's wealth, or should we be taxing their income? And that's a legitimate debate. You have to have wealth in order to make income, but then once you have that wealth, the income's not as important. So maybe this is a reason. I'm not going to say that I agree with this, but I think you're going to hear a lot about it. So I hope this was helpful when we talk about Elizabeth Warren's wealth tax, so you know what to look for.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.